Welcome to another video. Today we have another stock tier list, but in this video we will be reviewing recession-proof stocks. So some of the things that we'll be considering in the tier list are just their overall fundamentals, their predictability, but most importantly, how we believe that they would fare during a recession. And most of these companies belong to sectors such as energy, consumer defensive, real estate, or healthcare, which in theory have stickier demand, and when times get tough, people will still purchase products from these companies. So let's start with number one, which is the king of recession-proof stocks, none other than Walmart. Now this company is up over 70% for this year, but they have extremely consistent revenue growth, they even increased their margins in the previous years, and their balance sheet looks extremely good. Additionally, whenever there is a recession, people just won't stop going to Walmart. They still need to do their groceries, right? So for those clear reasons, and due to the fact that this company is an outperformer in recessions and in economic booms, I deem this company as a solid S tier. Next on the list we have Costco, which I believe operates in a very similar fashion to Walmart. However, I spot two main differences. The first one is their subscription model, which I believe can actually funnel a lot of growth into the business and provide more stability to their revenue growth. Currently they're undergoing an international expansion. They've opened stores in Europe, in Asia, and they're overall trying to capture a broader market from other countries. Of course, this involves higher risk than just staying in your country. However, so far they've been doing this incredibly well. So I can't believe that our first two stocks are S tier, but they have to be. Next we have Johnson & Johnson, which is an incredible company. However, it's not known for being a high growth stock. This company is actually quite the opposite. Their revenues, their gross profit, and their net income don't actually really grow from year to year, but they stay very constant. It's a very predictable company. They currently have a dividend yield of over 3%, and they're known to pay this dividend and increase it consistently even if there is an undergoing recession. So because this company is actually lacking the growth, I cannot put it in the first two tiers. But since I like their dividend and I believe that this company is as stable and as predictable as they come, I will have to put it in a B tier. Next on the list is one of the world's most famous companies, Coca-Cola. Since 2020, this company has been increasing its revenues. It went all the way from 30 billion, closing in on 45 billion, which for such a big and defensive company is not bad at all. And another point that goes in their favor is that they've actually been able to maintain very solid margins at between 20 to 25%. And honestly, even if I think of an economic recession, people will still be buying a Coca-Cola or a Fanta or a Sprite because at the end of the day, it's a very low cost and it has become a routine for the world to actually enjoy one of these soft drinks from time to time. This is why for me, this company goes into the A tier as it has more growth potential than Johnson & Johnson, but it's not as recession-proof as Walmart or Costco. Next in the list, we have Procter & Gamble, which offers a lot of personal care products, and they currently pay a very healthy 2.45% dividend yield, which has been paid for over 50 years, and they have been increasing it year after year. But I do believe that this is a similar case to Johnson & Johnson. They're not growing as much, but they're extremely predictable. Next on the list is American Electric Power Company, and this company basically engages in the generation, transmission, and distribution of electricity. We also have to consider that they provide some of their services to companies, and during recessions, companies are known to cut costs a lot, move to less expensive locations, or even use up less electricity. And I believe that this company's revenues actually have a lower predictability than Procter & Gamble and then Johnson & Johnson's revenue. Just because of that, I will put this company as C tier. Following up, we have American Water Works Company. This company provides water and wastewater services, which of course are needed by all Americans at all times. This company will still be providing their services even when there is an economic recession, and I do have to say that they have very consistent net margins that have stabilized above 20% and are increasing year after year. So this company to me is a B tier. Next we have ticker symbol CL, which is Colgate. Now this company offers very similar products to Procter & Gamble. They also pay a very nice dividend with a dividend yield of over 2%, and they have an incredibly predictable revenue growth. So this company will go straight into the B tier. Next we have Dollar Tree, and this company has had a horrible year, down over 40% in the past 12 months. They are basically stores which offer a wide variety of products at fixed prices. Of course, this usually outperforms in recessions because they get a lot of demand since consumers are more conscious on where they spend their money. However, this inherently means that the company has extremely tight margins. I'm a big fan of companies which can actually obtain a pretty good margin because it protects them from demand shocks, and this is exactly what happened to Dollar Tree. This to me is actually the first stock that will go into the avoid category. I'm not a big fan of this business model, and I don't think it's sustainable. Next on the list is the famous General Mills, which as well is trading near its 52-week lows. Now this company offers a very generous dividend yield, closing in on 4%, and they produce and sell consumer foods. But the thing is that we'll always need food, and especially when there is a recession, people tend to go less to restaurants and eat more at home, which is where General Mills actually comes in. Their revenue growth had been extremely predictable all the way up to 2023, where it actually slowed down and their total year revenue actually came in a bit lower than the prior year. So adding these up, I could see General Mills as a B or as an A tier. Next on the list is a very different company, Barrick Gold. This company engages in the production and the sale of different materials, especially gold but also copper. Now I believe that materials, especially gold, are a very good play and they allow to hedge your portfolio. But I would directly invest in a gold index rather than go to companies like these ones that are unpredictable and depend a lot on mining and different demand and supply factors. So to me, this is also going into the avoid category. Next on the list is the Kraft Heinz company, which is down over 20% and very close to their 52-week lows. This company mainly sells food and beverage products, and we all know their ketchup. However, they have been having a tough time, with their revenues finding it very hard to actually increase, with their growth rates being between 0 to 2% for a very long time. However, they currently have a 5.5% dividend yield. So to some of you, this may seem appealing, but I would recommend you to do a deep dive on the company before buying it only because of the dividend. To me, this company will go into the C tier. Next is McDonald's. I believe that this company does not need an introduction. It's currently yielding a 2.5% dividend yield. It has very solid margins, and the revenues have been increasing at a fair pace since 2020. Since this company has quite significant growth, and people tend to go there even when there is an economic recession, I will have to place this well-known brand next to Coca-Cola. Next we have Medtronic, which is a company that develops and sells medical devices to different hospitals. Now, hospitals will always need to treat patients, even if there is an economic downturn. However, in times of recession, hospitals also try to lower their costs and try to save up money. So there is a trend where hospitals try to spend a little bit less on renewing medical devices whenever there is an economic downturn. Now, on the other hand, this company has a dividend yield of above 3%, and they have a steady, stable revenue growth, which is in line with inflation. I believe I will put this company in the C tier. Next is Altria, which is a provider of different tobacco products. People still smoke during recessions because it's very hard to quit. These people have developed addictions, which makes them need to smoke even if they're having a hard time financially. Having said that, if I were to buy one of these companies, I would prefer to go for the leader of the sector, which is Philip Morris, so I will end up putting this company as a high C tier. Coming up, we have NextEra Energy, which is also in the energy industry as its name indicates, but it provides renewable energy. Of course, people will need energy, but one of the doubts that I have now is, with the new government in place, will they still focus a lot on providing renewable energy, or will they go the other direction and provide cheaper, more accessible energy for all their consumers? Well, due to this uncertainty, and due to the fact that in recessions, people usually go for the cheaper alternative, I will have to put this company at a C tier as well. Next we have Realty Income, which is trading very close to their 52-week lows. Now this is because companies in this sector are very sensitive to interest rates. Whenever interest rates are higher, these companies find it a lot harder to grow and they have a lot more expenses because one of their main expenses is interest expense. Having said that, since this is a real estate company, they generate very consistent income, having a dividend yield of close to 6%. Whenever there is a recession, interest rates are usually lowered, which inherently would raise the price of companies such as Realty Income. Having said that, this company will get a B tier. Next on the list we have PepsiCo, another company which is trading near their 52-week lows. It seems like all recession-proof companies are trading very low at the current moment, but this company currently has a dividend yield of over 3.5%, and for those of you who don't know about this company, well, they engage in the sale of different beverages, foods, and snacks. And this company has been growing their top line at a very sustainable pace at growth rates of between 5 to 12% for the past 4 years in an extremely consistent manner, and they also managed to do this throughout a recession. Adding to this, this company has one of the most solid net margins that I have seen, being above 10% since 2018. To me, this company is a clear A tier. Next we have Philip Morris, which as discussed, I believe is the better play if you want to go over the tobacco producers route. They recently unlocked a very profitable growth avenue, which is their IQOS brand. They sell this like the safer cigarette option which is generating big success all over the world. Now, this company has a dividend yield of over 4%, and their revenues in 2023 grew at an 11% in comparison to the prior year. And to this, you have to add that their net margin has been above at 20% all the way back to 2017 and even further back. To me, this company is an A tier, even if I don't like their offering. Next is Public Storage, which is a company I did not know about and I found when researching about this video. And they engage in acquiring and renting out self-storage facilities. Now, people will need space, and usually when you're renting out space, it's not a big portion of your monthly budget. And when you take into consideration that it's usually more of a hassle to go to this self-storage facility, take your stuff out and find another place to leave it in, than to just keep making those monthly payments. So I will place it in front of realty income. Next on the list is AT&T, which has had a stellar year, up over 30%, paying a dividend yield close to 5%. However, their revenues are not increasing, they're actually falling. In 2019, they were having revenues of 180 billion, and now in 2023, they're having revenues of 122 billion. So that's $60 billion in revenue, or 33% of the previous baseline, lost in only 5 years. To me, this is a company that you should avoid. Next is Target, and this is a very similar company to the top two, Walmart and Costco. This company is yielding a 3.25% dividend yield, and their revenues had been growing at a quite predictable pace all the way up to 2022, where the revenue growth actually slowed down. And in 2023, this growth went into negative territory, decreasing by 1.5%. This company has also been facing a lot of issues with theft in their stores, and when we look at their most recent margins, they were 3%, which is very low. To me, I will put this company as a C tier. Next on the list is United Health, which basically offers health insurance. It has a dividend yield of 1.58%, but the great thing about this company is that its revenues are growing non-stop, and they're growing at a pretty fast pace, growing between 8 to 13% year after year after year. Having said that, their margins are actually decreasing, and I believe that currently the American healthcare system is under a lot of pressure. I believe that we have a low A tier or a high B tier if we also take into account the uncertainty and unsustainability of the sector. Next on the list is VICI, which performs in a very similar fashion than Public Storage and than Realty Income, because it's also a REIT. Having said that, since 2021, their revenues have grown at 20+% year after year. I would put this company at between A and B tier, but since those at A tier have more growth potential and are less dependent on macroeconomic factors, I will put VICI as a B tier as well. Next on the list is Verizon, which is a close competitor to AT&T. And although this company has not suffered as much as AT&T with their revenues, they're also having a lot of years where their revenue growth is negative, and the other years where they're actually growing, their growth rate is between 0 and 2%. So this to me is also a predictable business that is extremely recession-proof, but I don't see much growth potential in them. They do have a fantastic 7% dividend yield, but to me there is a lot of risk. I won't be putting it in the avoid as AT&T because they're being handled better, but I will put it as a low C tier. And for the final two, first of all we have Waste Management, which, as the name suggests, they engage in waste management services, paying a smaller dividend of 1.4%, which is still good, and having very consistent revenue growth. Additionally, since 2022, they have managed to grow their net margins, and they have currently been sitting at above 10% for the past 2 years. So this company to me will go in the B tier. And last but not least, we have ABBV, a pharmaceutical company, which, when you think about it, if you have a healthcare problem, you will usually put that first, even if you're in a tough financial condition. And although this company had been growing at a very fast pace from 2019 to 2021, in 2022 this growth rate slowed down, and in 2023 their revenues actually contracted by around 7%. Additionally, in that same year, net margins went from 20% to a 9%. And although I like this company, and I believe that it's recession-proof, I'm unsure of how predictable they are, because a lot of their growth and a lot of their potential comes from products that they have in their pipeline, meaning that a lot of these products could end up not being approved, and that would impact the stock heavily. Since this company does not have a lot of predictability, I will put it in the C tier. If you're still watching this, thank you, you're a legend. Let me know what other stock tier lists you want to see next. Thank you for watching. As always, this has been the Cashflow Compounder. I'll see you in the next one.